Procter Gamble's Q4 2026 earnings just crossed the wire, and, well, they missed consensus estimates on both the top and bottom lines.
Yeah, it's a tough look right out of the gate.
It really is. So here's the reality check for you. Diluted EPS came in at $1.26. That is a 15% plunge versus the prior year.
Ouch.
Right. Core EPS landed at $1.43, which is down 3%. And then as for the top line, Q4 net sales hit $21.2 billion. So that's up 2% year over year, but organic sales, completely flat. 0% growth.
Zero.
Exactly zero.
Yeah.
And looking ahead, I mean, their FY27 guidance is incredibly soft. They're pointing to a massive $1 billion commodity headwind, and the stock is already taking a hit in pre-market trading.
I mean, zooming out just a bit to the full fiscal year 2026, net sales did reach $87.0 billion, which is a 3% increase, and core EPS was at $6.89, so up just 1%.
Right.
But, you know, that 0% organic growth figure for the fourth quarter, that is the number that is really dictating the market's reaction right now.
For sure. A 15% drop in diluted quarterly earnings and totally flat organic sales sets an incredibly heavy tone. So today we are tearing through P&G's Q4 earnings report, the CEO commentary, and their FY27 forward guidance to answer one central question.
How long can a consumer staple giant shrink its way to prosperity before the consumer completely breaks?
Exactly. Because when organic growth zeroes out, you really have to look at what's masking the bleeding inside the portfolio.
And, well, that bleeding is entirely tied to volume.
Yeah.
If you break down the 5 operating segments, the very first thing that jumps off the balance sheet for the fiscal year is that volume and product mix were effectively unchanged for the entire 12 months.
Wow. The whole year.
The whole year. That means pricing did virtually all the heavy lifting to keep those revenues afloat. And, you know, in the retail sector, when your formula for sales growth relies entirely on price hikes rather than moving more physical units, you are walking a very fine line.
You're testing the elasticity of demand, right? Like every single time a shopper walks down the grocery aisle. Because eventually, you know, the shopper looks at the price tag on a bottle of premium shampoo and decides, well, the store brand is perfectly fine.
Right. They just trade down.
But clearly, if the overall organic average is zero, something inside this massive portfolio is pulling hard in one direction while something else collapses in the other. So where is the strength right now?
Well, beauty was the undeniable star of the quarter. Organic sales in that segment were actually up 4%.
Okay, 4% is solid.
Yeah. It was driven heavily by hair care volume growing in the Asia-Pacific and European markets, and they paired that with some strategic, innovation-driven pricing in Latin America and Asia-Pacific.
Got it.
They also benefited from a favorable geographic mix, you know, selling more in regions where they command higher margins. But
there's a catch.
There's always a catch. Even the star player of the portfolio had a noticeable limp. Skincare organic sales were completely flat.
Really? Just flat?
Yeah. And that is directly because volume declines in Greater China severely impacted the growth of their super premium SK-II brand.
Right. I look at P&G's sprawling portfolio a lot like a retail investor's diversified mutual fund.
That's a good way to frame it.
Right, because when one blue chip asset drags like that super premium SK-II skin brand, suffering from those volume drops in China, well, another asset has to step up and lift the whole fund.
Right.
And we saw North American personal health care doing some of that lifting this quarter with higher pricing and volume. But if beauty is the only segment actually growing organically, what is happening in the core household categories, like the stuff people supposedly buy no matter what the economy is doing?
Well, they are completely stagnating.
Ouch.
Yeah. The grooming segment and the fabric and home care segment were both dead flat, 0% organic growth.
Wow.
Now, fabric care actually saw a low single-digit bump, primarily from European volume growth, which, you know, is a positive signal. But that progress was entirely wiped out by home care, which suffered from sheer volume declines right here in North America. Consumers simply bought less product.
Which brings us to the segments that actually pulled the company average down to zero. The laggards.
Exactly. Healthcare dropped 1%, taking a hit from oral care volumes dropping in North America and Greater China.
Okay.
But the biggest drag on the entire P&G portfolio was the baby, feminine, and family care segment, which was down 2%.
A 2% drop in essentials like that is rough.
It is. Family care specifically dropped mid-single digits. We saw strict volume declines there. And to make matters worse, management had to make heavy merchandising investments just to move the product they did sell.
Wait, let's pause on that phrase, merchandising investments, because, I mean, that is just corporate speak for promotional spending and discounting.
Yeah, pretty much.
That means P&G is having to pay for prominent end cap displays at the grocery store or, slap yellow seal stickers on toilet paper and paper towels just to keep consumers from trading down to cheaper generic brands.
That is the exact mechanism at play, and it highlights why we are likely seeing the consumer's breaking point in real time.
Yeah.
Because when stagnant volumes become the norm, a company is forced into a defensive posture. You can only pull the pricing lever so many times before demand destruction kicks in.
Right. You price them right out of the brand.
Exactly. If you have to heavily discount your premium paper towels just to maintain market share, you are fighting a war on costs just to protect your bottom line profits.
And when you have zero volume growth and heavy discounting in family care, I mean, that blood is immediately going to show up on the gross margin line.
Yeah.
Which transitions us perfectly into the margin profile for the quarter.
Yeah, it does.
Because it looks like a brutal tug of war behind the scenes.
Oh, it really was. Core gross margin was completely flat year over year.
Okay.
On the positive side of the rope, management managed to cart out 160 basis points in productivity savings. They also secured a 40 basis point net benefit from recognized tariff recoveries.
So they aggressively manufactured 200 basis points of breathing room through internal efficiencies alone. I mean, in a company of this size, generating 160 basis points of productivity savings is a massive operational lift.
It's huge.
That involves optimizing supply chains, squeezing suppliers, tightening up manufacturing.
Exactly. But that hard-fought 200 basis points was entirely wiped out by the other side of the rope.
Here we go.
They took a severe 120 basis point drag from unfavorable product mix. And on top of that, higher commodity costs ate up another 40 basis points, and they had 70 basis points of product and package reinvestments.
I want to drill down into that 120 basis point drag from unfavorable product mix. Because to me, that is the financial fingerprint of a stressed consumer.
Absolutely.
Unfavorable mix means shoppers are actively shifting their buying habits, right? If a family stops buying high-margin premium laundry pods and switches to lower-margin basic liquid detergent.
Or downgrades from a premium Gillette razor to a disposable one.
Yes, exactly. P&G's overall profit margin shrinks. Even if the total dollar amount of sales stays exactly the same, the profitability of those sales is just inferior.
Precisely. You are seeing the physical manifestation of inflation exhaustion in the product mix. And the pressure on margins doesn't stop at the gross margin line either. If we look further down the income statement at SG&A selling, general and administrative expenses, those spiked 130 basis points on a core basis.
That's a big jump.
Yeah, the company spent incredibly heavily this quarter. Like 410 basis points went straight into reinvestments, primarily into marketing campaigns.
Wow.
They tried to offset that massive spend with 300 basis points of productivity savings, which, involved deep cuts across marketing overhead and general corporate overhead. But the expenses still heavily outpaced the savings.
Wait, let me stop you there. They slashed 300 basis points in operational overhead. Just to dump 410 basis points right back into marketing.
Yeah.
And they still walked away with 0% organic growth.
That is the reality, yeah.
I have to push back on the strategy here. It sounds like P&G is experiencing the Red Queen effect from Alice in Wonderland.
Oh, I like that analogy.
Right. They are running on a treadmill, cranked to the highest speed, exhausting their resources just to stay in the exact same place.
Yeah.
Is this aggressive productivity actually generating real enterprise growth, or is it just setting cash on fire to keep the company from drowning?
Well, that is the multi-billion-dollar question. And the data right now suggests they are indeed spending more just to stand still.
Yeah.
When a company has to outspend its own aggressive cost savings just to keep organic volume from going completely negative, it highlights a severe lack of operational leverage.
Sure.
I mean, they are putting the entire organization through the ringer cutting staff, closing facilities, optimizing every cent of overhead, all for zero top-line organic growth.
This treadmill dynamic perfectly contextualizes the commentary we got from CEO Shailesh Jejurikar in the release.
It really does.
Because when a company is cutting to survive rather than cutting to grow, the narrative from the top usually shifts to long-term restructuring.
And the CEO's language was very deliberate. It confirms exactly what you're pointing out. He explicitly called fiscal 2026 a year of foundation building.
Foundation building.
Yeah. He cited a, quote, very challenging geopolitical and economic environment. Looking ahead, their FY27 strategy relies heavily on delivering what he called superior products at a superior value.
Superior value. Interesting.
Management is banking on stronger, integrated execution to accelerate growth from semester to semester. And they made sure to note that these future investments will be funded by a strong, ongoing productivity program.
See, foundation building is a classic Wall Street phrase. It almost always translates to, please do not expect explosive growth right now while we tear open the walls and fix the plumbing.
Exactly.
And fixing that plumbing is proving to be incredibly expensive for them, right?
It is remarkably expensive. Back in June 2025, the company announced a massive portfolio and productivity plan.
Right, I remember that.
So the stated goal is to streamline the portfolio and the organization to improve the cost structure and, free up capital to invest in growth. But to execute that, management is taking a $1 to $1.6 billion before tax non-core restructuring charge.
Over $1 billion just to restructure.
Yeah. They incurred over half of those massive costs in this fiscal year, FY26, and the remainder of that charge is expected to bleed directly into FY27.
Let's look closer at that restructuring because there is a very specific detail in their forward guidance that caught my eye.
Oh, yeah. What's that?
P&G is projecting a 30 to 50 basis point headwind next year, specifically from discontinuing certain brands and product forms.
Right.
So I have to ask, is streamlining the portfolio just corporate spook for quietly killing off unprofitable products? Because consumers are trading down and those premium items simply aren't moving off the shelves anymore.
That raises a critical point about their long-term strategy. And honestly, yes, it absolutely is.
I knew it.
Trimming 30 to 50 basis points of organic sales explicitly through product discontinuations strongly suggests they are clearing out dead weight.
Yeah.
When inflation squeezes the consumer, fringe products or premium adjacent forms that require high marketing spend and valuable shelf space to justify their existence, well, they suddenly become severe liabilities.
Makes sense.
P&G is essentially admitting to the market that they have to shrink the overall portfolio slightly to protect the broader margin profile.
Cutting dead weight makes sense in a tightening economy. But as retail investors, we need to know exactly what the math looks like for the coming 12 months.
Absolutely.
Which leads straight into the FY27 guidance. And you mentioned at the top that the market is punishing the stock because this outlook is just so cautious.
It is incredibly conservative. They expect all-in and organic sales growth to be in the range of just 1% to 3%.
Okay.
And for the bottom line, P&G expects its core earnings per share growth to be in the range of in line to 3%.
In line to 3%.
Yeah. That equates to a range of $6.89 to $7.11 per share, which gives us a midpoint estimate of exactly $7.
So we are looking at 1% to 3% top-line growth.
Yeah.
I mean, in a macroeconomic environment where inflation has remained sticky at around 3%, projecting 1% nominal sales growth means they're effectively bracing for negative real growth.
Yeah.
They're barely treading water.
And that modest 1% to 3% growth target is facing massive operational risks that management was forced to explicitly call out in this report.
Like what?
Well, P&G is staring down a $1 billion after-tax headwind driven by higher raw materials, energy, and transportation costs.
$1 billion.
$1 billion. When you calculate the impact of that, and then you add in $150 million from higher net interest expense, another $150 million from lower non-operating income, and $50 million from unfavorable foreign exchange rates.
Wait, it just keeps adding up.
It does. It equates to a massive 56 cents per share drag on the bottom line.
56 cents per share. Just to put that in perspective for you, based on their $7 midpoint estimate, the $1.56 headwind eats up 8% of their core EPS growth before the fiscal year even officially gets off the ground.
It's brutal.
That is a steep, steep hill to climb just to break even on profitability.
It is a phenomenal amount of pressure. $1 billion headwind from raw materials and energy alone means their cost of goods sold is going to skyrocket at the exact moment their consumer base is refusing to accept further price hikes.
Right. They can't pass the costs along anymore.
Mm.
But, if there is a silver lining here for investors, it lies in the balance sheet mechanics.
Sure.
Despite these massive operational costs, despite the completely flat volumes and the pricing exhaustion, P&G remains an absolute cash-generating machine.
Oh, without a doubt.
Yeah.
Their ability to convert earnings to cash is exceptional, and it is really the main reason the stock maintains a premium valuation.
Yeah.
Adjusted free cash flow productivity hit exactly 100% for the full fiscal year 2026.
Let's define that really quick.
Sure. They define that metric as operating cash flow less capital spending. expressed as a percentage of net earnings. So hitting 100% means every single dollar of adjusted net earnings translated directly into a dollar of liquid free cash flow.
That's impressive.
And in the fourth quarter alone, that productivity spiked to 133%.
Okay, we have to unpack why 133% cash flow conversion in a single quarter is a bit of a double-edged sword.
Go for it.
On one hand, it shows tremendous financial discipline. On the other hand, when you achieve that kind of conversion while organic growth is flat, it often means you are squeezing the sponge completely dry.
Right.
You are aggressively managing working capital, delaying payables, and potentially cutting capital expenditures, which means you aren't investing in new factories or long-term growth. You're just trying to maximize cash in the short term.
That is a crucial distinction. They are optimizing for cash extraction right now, not aggressive expansion. And that cash generation is exactly what fuels the engine for shareholder returns. For FY27, despite all those headwinds we just discussed, they are planning to pay out around $10 billion in dividends and repurchase approximately $5 billion in common shares.
That is $15 billion in expected capital return, which is identical to what they returned in FY26. It provides a massive, reliable floor for the stock, completely regardless of the sluggish organic growth.
Right. Which brings up a critical metric for any retail investor holding the stock for the yield. Back in April 2026, P&G increased its dividend.
A big milestone, wasn't it?
Huge. That marked the 70th consecutive year that P&G has increased its payout. Not just maintained it, but actively increased it.
Wow.
Yeah, that is a 70-year streak spanning multiple severe recessions, historic inflation spikes, and massive geopolitical shifts.
It's an incredible streak. And it is a testament to the core durability of consumer staples. Because, people still fundamentally need toothpaste, laundry detergent, and diapers, regardless of whether the broader economic environment is booming or busting.
They do. But the mechanics of how management is funding that dividend today is the real story hidden inside this earnings report.
Yeah.
Because they are securing that payout through heavy billion-dollar restructuring charges and aggressive internal cost-cutting rather than through organic consumer demand.
So what does this all mean for your portfolio? I want to leave you with a final thought to mull over as you digest these numbers. With a $1 billion commodity headwind looming on the immediate horizon, zero organic volume growth this quarter, and consumers visibly balking at higher prices by trading down to store brands.
Yeah.
Wait, I shouldn't trail off. Consumers are visibly balking at higher prices by trading down to store brands. So P&G's legendary 70-year dividend streak is increasingly being funded by ruthless internal cost-cutting and stock buybacks rather than actually selling more units.
It really is.
So the question is, how long can a consumer giant shrink its way to prosperity before the productivity savings completely run dry?
It is the defining tension of their entire fiscal 2027 strategy. Management has to find a way to reignite actual volume growth without sacrificing the margins they've just spent billions of dollars restructuring to protect.
Right.
If they can't balance that equation, the foundation they are supposedly building right now might start to crack.
Well said. Make sure you follow the show for our daily earnings coverage to stay ahead of the markets.